to focus on the commodity channel index, which is usually referred to as the CCI. Now, this indicator was originally built for the stock market in order to identify price cycles in various stocks or commodities, but nowadays it's used in every other trading environment, including the Forex market. So when we load up our indicator, we see two lines. The first line is this top line here, which is the plus 100 line. The second line, which is this low line here, is the minus 100 line. So when we're using the CCI indicator, what we're looking for are readings above the plus 100 line or readings below the 100 line. The reasons why are because when we have a reading either above 100 or below 100, we say that prices are away from their normal price range. So, for example, when we have a reading above 100, we say that prices are in a strong uptrend. When we have a reading below 100, we say that prices are in a strong downtrend. Now, the indicator can help us to trade in two ways. The first way allows us to get into the current trend that's taking place, and the second way allows us to get into a new trend that's just about to start. So let's see how we can use it in both of those circumstances. So when we're looking to get into a trend using the CCI indicator, the first thing we must do before we even look at this indicator is to establish that a trend is already taking place. And for that, we need two indicators. The first indicator are moving averages, and the second indicator is the momentum indicator. So let's see how moving averages will help us. The first moving average I've got here is a 10-period moving average, and the second moving average is a 20-period moving average. So what we're looking for is a crossover of the 10-period moving average over the 20-period moving average if we're looking to trade in the upwards direction. And that's exactly what we've got at this point here. If we were trading the opposite way, what we would look for is a crossover of the 10 moving average below the 20-period moving average. But as we're looking to trade in the upwards direction, we have the relevant crossover here. So in this area here, because of the fact that we already have a historical uptrend, we're not sure whether this area is a beginning of a new downtrend or a consolidation or a pause of the current uptrend. And this is where this crossover has helped us. So as soon as we get this crossover, we know that there is a good chance of this uptrend continuing to go in the upwards direction. So in order to confirm this uptrend, we're using the momentum indicator. Now, the key area of the momentum indicator is the 100 line, i.e. a line with a reading of 100 like you can see here. And in simple terms, when the reading is above 100, the market is in an uptrend, and when the reading is below 100, the market is in a downtrend. Now, we're not going to go into how to specifically read this indicator or the moving averages indicators. We have other videos dedicated to that. So if you're not familiar with both of these indicators, watch those videos first before you come back to this lesson. But if you are familiar with them, then please stay in this lesson. In this lesson, we're simply going to tell you how we use the momentum indicator for the purpose of using the commodity channel index. So the reading over 100 in the momentum indicator shows us that the current prices are actually in an uptrend. So in terms of putting all of those readings together, all we need to do is put a vertical line at the point at which the moving average is crossed over to identify that at the same time the momentum indicator is reading above 100. Now that we've done that, what we're looking into is the CCI indicator. We don't need to concern ourselves with the moving averages or the momentum indicators anymore. So the first thing we're looking for is for an extreme CCI reading in the opposite direction of the trend that we established in the first place. And that's exactly what we've got here. The reason for this is because it ensures for us that a low-term correction has now taken place and the uptrend is now ready to continue back up in the upwards direction. And the last thing we're looking for is a break above the plus 100 line, and that's exactly what we've got here. So to put it all together, we have a crossover of the moving averages, we have a positive reading in the momentum indicator over 100, we have an opposite reading to the trend that we've established in the CCI indicator that confirms for us that this is a pause in the current uptrend, and then we have a reading above 100 in this area here in the CCI indicator, and this is the point at which we take the trade. And this is the candle here that we would use to get into this trend that's already taken place. This indicator can also be used to get us into new trends that are taking place. And for that, we used divergence. So I'll explain a little bit better. So prices here are making brand new lows. So we've got a low here and a low here. However, the readings in the CCI indicator are showing us something different completely. They're showing us positive readings. So we've got a low there and a higher low here. So this is where prices and the indicator are going into opposite directions, and that's what we mean by divergence. As soon as we get a reading above 100, which is here, that's when we get into the market. So that'll be this candle here. Okay, so despite the fact that when we were trading a trend, we waited till we have the crossover here, when we trade reversals, we're looking to get into a trend as soon as we have an extreme reading over 100 in the CCI indicator. So in this example, even if you got into here, or if you got into the trade here, you will still make a profit because your stop loss will be in this area there.